Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we do these free mentoring roundtables week after week after week. This is the 458th session. We started way back in 2008, September, and we started experimenting with this format of mentoring, and then the 1 million by 1 million program emerged out of that experiment. So these roundtables have been key in our delivery model of how we deliver the program. We have numerous private roundtables, members-only sessions going on as well that you don't normally see unless you're a member. But the online mentoring has been very critical in our process. Okay, the event is being recorded. Every single roundtable until now is recorded and available on our YouTube channel. You can go look them up, and this is going to join that body of work on the channel as well. If you're live tweeting the show today, the hashtag is 1M1M, and our Twitter handles are at 1Mby1M and at Shromana. We publish constantly very interesting content. This is a roundtable, not a broadcast, so we want everybody to participate. Make a note of the numbers. I will put the slide back up later. To begin with, we have some scheduled programming, but we will have time for Q&A. We will have time to listen to every one of you who wants to share something or ask questions. So there will be open Q&A a bit later. Today, we're going to start the session with a conversation with Alok Nandan, General Partner at Emergent Ventures and also founding partner of Arca Venture Labs. Alok, welcome to the show. It's great to see you.
Likewise. Thank you, Shamana. Thanks for having me on the show.
You have this halo around your head. Feels like you're emerging out of the mist with, you don't need to change anything. I'm just teasing you.
Okay. No, I blurred my background because I'm sitting in yeah.
Looks great, actually. Looks kind of surreal. All right. So let's start by introducing you to our audience. So tell us a bit about your background as well as about Emergent Ventures.
Sure, absolutely. So my name is Alok Nandan. Yeah, I joined Emergent as a general partner in 2017. My prior background is I've spent about 15 years as a product guy in enterprise software companies, both big and small. I started my career in Microsoft up in Seattle. I was there for about 7 years. I was one of the founding product managers of Windows Azure. Satya at the time was our VP, so presented to Satya a few times as well. I moved to Silicon Valley about 8 years ago. I was lucky to be part of a couple of startups here. One was a company called Umi Networks. I joined them when they were about 50 people, and in a couple of years, they went to 500 full-time people, and they IPO'd on the New York Stock Exchange in 2013. So I was lucky to be part of that IPO. After that, I was part of another startup here in Menlo Park called Tempo AI. This was incubated in SRI, Stanford Research Institute, where Siri came out. And what we were doing was building a Siri for the enterprise. And in fact, the inventor of Siri, Norman Winarski, he was on the board of this startup as well. So we were a small startup, about 10 people. After about 2.5 years, we got some traction in the sales vertical. A lot of salespeople would use it, and after about 2.5 years, Salesforce acquired us. So I was in Salesforce for a year as a director of product, integrated, relaunched the product, and then around that time started helping early-stage startups with product market fit and go-to-market strategy and so on. And that's how I ended up in venture capital. And delighted to be here. And Emergent is an early-stage fund. We do enterprise software investments only. And we are based in Silicon Valley. Our typical check sizes is, up to $1 million. So think of us as the first institutional check into a company. And we are very hands-on. Given my background, I roll up my sleeves and work with the entrepreneurs to get them to their first 3 to 5 customers. So that's in a nutshell about myself and the fund. Yeah.
Let's double-click down a little bit on Emergent and the specifics of the fund. How big is the fund?
Yeah, so Fund 1 was started in 2016. It's a $25 million fund. We will do about 12 to 15 investments out of this fund, about $1.5 million per company. So about $1 million in the first round, in the seed round, and about similar in follow-on in Series A. And our model is to lead the seed round. That's what we have done for about 10 companies already. Yeah.
Okay. Now, how do you define seed in your worldview? Because I'm sure you're watching this trend out there. The seed has fragmented, right? It's now pre-seed, seed, post-seed. Well, friends and family, pre-seed, seed, post-seed, pre-series A, small series A, large series A. So
correct.
Where in that continuum have you positioned yourselves?
Yeah, that's a great question. So, the way we look at it, you're absolutely right. There's a lot of noise around what exactly is seed, and there has been different sort of definitions thrown around. Our viewpoint is, if you think about the entrepreneur's journey, right, typically the first round tends to be their own capital or some friends and family, and then there is a large gap to get to a Series A, where the bigger funds come in with an $8 to $10 million round, right? So we operate in this large spectrum where they have raised some capital from friends and family. They are maybe building a product, and now they want to get to 3 to 5 customers so they can be actually ready for a Series A, right? So that is the space we play in. Now, some people in the Valley may call it pre-seed. $1 million check in the Valley today is probably pre-seed. We also do some cross-border stuff where startups are coming out of India. For them, $1 million is still considered a seed, right? So it depends on who you're talking to in the entrepreneur side as well. In the Valley, probably I think it's a mix of and again it depends on the whether it's a B2C consumer startup or an enterprise startup. But in the enterprise space, I would say a $3 million seed round is still pretty common, with we leading sort of $1 million, $1.5 million, and then maybe another fund co-leading with us, or the founder filling out the round with smaller angel checks. Does that make sense?
So let me probe that for a moment. You said companies that have launched a product and are getting ready to get their product in the hands of 3 to 5 customers. Did I hear that right?
Correct. Yeah. Ideally, they should have at least some MVP, some semblance of a product, and that's when we sort of engage. I mean, having said that, there are always exceptions.
Not necessarily a customer. You are okay with three customers.
Not necessarily. Yeah, not necessarily with a customer. They should have some MVP product that they can show. That is where we sort of that's sort of our sweet spot. Having said that, there are exceptions. There may be founders which are repeat entrepreneurs. For them, even if it's a PowerPoint deck, if it's a very compelling idea and the entrepreneur and the team is sort of seasoned at what they're doing, then we may come in at that stage as well. But typically it is when they have a semblance of a product, they may or may not have customers, and we engage with them and help them get to first 3 to 5 customers.
So, our community is going to be largely first-time entrepreneurs. And very often what we hear from investors is that they don't want to invest in first-time entrepreneurs until they have some customer validation. That's just a comment, that's just an observation about what's happening in the industry. Repeat entrepreneurs is a very different story.
Yep.
So you said enterprise software is your primary focus. Elaborate.
Correct.
What trends are you seeing? What trends interest you? Of course, I'm sure you're going to say AI, but get more granular.
Yeah. Yeah, absolutely. Yeah, so there are two specific areas within that we look for, and we broadly define the area that we look for is what we call intelligent software, which is software that becomes better with use. And it's another. We think it's a more simpler way of describing a software that is enabled by AI, right? It's basically becoming
Learning
better
technology.
with use. Yeah. And then in terms of specific sub-segments within that, we look at cloud infrastructure. So to technologies and infrastructure that's powering these applications, these intelligent software applications, that's an area of interest for us, and we have done investments in that. And then within the intelligent software space, we look for specific use cases which have sort of a business focus. So for example, AI for a specific sales use case, like sales forecasting for AI, or it could be something in the marketing space, or it could be in the customer support space. So, apply what we call applied AI or for a specific business use case. That's of interest to us. And then we have done investments in all of these areas. For example, there's a company called BoostUp.ai, which is in sales forecasting AI. That is one of our investments. There's a company called SupportLogic.io. That's AI for technical customer support. That's one of our portfolio companies. Yeah.
Now, you said geography-wise, you are doing cross-border with India, and does that mean that you're doing all over the United States and cross-border with India? Is that accurate geography?
Yeah. Yes. So I'll double click on that a little bit. So what we are looking for is entrepreneurs which have the ability to build teams outside the Bay Area. Bay Area, as you know, today has become super expensive, especially for hiring engineers, right? And with the check size, with the check sizes we come in, it's very, very difficult to build a product, right? With the engineers here, right? So what we are looking for is entrepreneurs that can build a team outside the Bay Area. And we have invested in companies which have a team in Atlanta, which have a team in Austin, or could have a team in Seattle or even Salt Lake City, right? So that's fair game, right? So anywhere where there is talent, as long as one of the founders is in the Bay Area, that's fair game. Now, India is interesting. There's a lot of enterprise SaaS companies coming out of India. Now, we find them here. And usually what happens is the founder is in Silicon Valley and we meet them here, right? So we typically invest when they are already here. And then maybe that part of their team, engineering team could be in Bangalore or something like that, right? So that sort of is the model that is ideal for the companies that we invest in.
Okay. Now, talk a bit about trends. If you look at the last 18 months of your deal flow, what are you spotting by way of trends? Synthesize for me what's out there that's worth talking about.
So I think one of the big trends is around obviously AI is infusing every aspect of a business process. I think the next trend, and we haven't made an investment in it yet, but is around the explainability or the accountability of AI, which is around, how do you make sure that your machine learning models are actually explainable to a human being as a, in what they're doing, right? They're not like a black box, right? So that is an important trend, I think, which will apply to most of our portfolio companies as well as other companies out there which are using any sort of machine learning or AI, right? Which is around this explainability and accountability of these AI models. And McKinsey has a report also
I have
on
a
this.
question about this before we go on to the next point that you were going to make. I've been thinking about explainability. So your learning models start evolving, right? You have a learning model buried into any workflow function, whether it's sales, marketing, sales forecasting, whatever. And then the learning model starts to kick in gear and it starts making decisions, starts getting smart. To what extent do you see the engineers and the architects of these systems simulating where is this learning model going to go?
Maybe I'm not fully understanding your question. So when you say where will the machine learning model go in the sense that how will it evolve?
Yes, because
Yeah.
as an architect of an AI system, you set up the heuristics on what's going to happen, how your machine learning model is going to evolve. But the data comes in and the machine learning model starts evolving. To what extent can you control that evolution is the question that I'm asking. And, it kind of relates with your explainability question.
Absolutely. Yeah. So, I think what companies will have to do is build guardrails around these models, where if the model starts to produce results that are beyond a certain expected sort of spectrum of results, then I think it needs to be flagged automatically, right? You can write software to automatically flag it, right? That, hey, this model is quote unquote behaving badly, right? Or not as expected, right? So I think that is doable, and I think that will happen. And I'm pretty sure that's already happening. For example, in Salesforce has an Einstein group, and they have some of these checks and balances. At least they were talking about it a year ago, right? So, which is around having these guardrails built in so that a novice user or even a sort of a semi-expert user doesn't shoot themselves in the foot with the AI model, right? So these guardrails are being built, and I think there will be more and more. And the more sensitive the area, for example, if it is an HR, and the model is deciding whether to hire somebody or not, and the data is somehow biased in one manner or another, then how do you control that, right? How do you have checks and balance, right? So there will be more and more work. I think it's also, I believe, a research topic, and so there'll be more research on this, as well as there'll be more product innovation around building these guardrails so that they're automatically caught when the models go out of bound, let's say, or out of the expected spectrum of results.
One of my concerns is that the first wave of AI models don't have guardrails, and they're going to come up with a lot of, questionable. I mean, sales is probably not the most risky territory, but HR, as you pointed out, is a more risky territory. And then if you move on to stuff like medical, healthcare data and stuff like that, that gets into very risky territory.
Yeah, I mean, I think you can't, with healthcare, I think there has to be a human in the loop, right? I mean, it cannot be that the machine is producing a result and there isn't a human reviewing that result before an action is taken, right? So I think for healthcare, even for financial services, right? Like, I'll give an example, right?
Yeah.
Let's say there's a model that decides whether somebody is creditworthy or not. And based on that, gives out a loan or not, right? Now there could be some bias built into the model, right? That, and so there has to be, and that's where this explainability comes in, and that's where sort of a human in the loop has to be in the decision-making path, today to provide that checks and balance, right? And I agree that there is a lot of hype. Sorry, go ahead. Yeah.
Fintech is a segment where there isn't a lot of human in the loop, because one of the great benefits that AI is delivering within the fintech, especially lending space, if you look at small business lending and, credit in general, all these fintech credit companies, their, claim big value proposition is that we approve loans within 30 seconds or 30 minutes or whatever, and there is no human in the loop. That's the whole raison d'être is to, to do it quickly.
I think they're fine. I think you're absolutely right. But I mean, AI, I mean, you can still run it. I mean, human in the loop. See, if it falls within a certain range, then I guess it will automatically get approved, right? And humans may only get pulled in if there is exceptions to the rule, right? So you can still do some of that fast processing with a human in the loop, because human is not reviewing every outcome that the model is doing. It's only reviewing the exceptions, right?
Yes, that's right.
Or the ones that are outside of the kind of the expected spectrum of results. Let's say, yeah. But you're actually absolutely right. I think this is, and I believe financial services are waking up to this. I think there's more and more accountability of the models being built in as we speak. And the fintech companies are definitely at the forefront of this in terms of adoption of these newer techniques. Yeah.
So switching gears a bit, which of your portfolio companies are you most excited about, and take us through an analysis of how did you encounter this company? What did you see that triggered your interest in investing in the company? And what I'm trying to do here is provide a couple of examples so that our audience can understand how you analyze deals.
Sure. So one of our portfolio companies is a company called Observe.ai, and they are in voice analytics for call centers. So I'll give you first the use case and then talk about the journey and how they're doing right now. So typically, whenever, we in the US at least, whenever we call a customer support, let's say you're calling Comcast because your internet is down, right? There is a voice that says that your voice may be recorded for quality assurance purposes, right?
Yep.
But what they do is most of these voice recordings are just sitting there. And once in a while, 1 in 100 calls, there will be a QA rep who will listen to the call, manually fill out a paper-based assessment as to how the call went. Was the customer happy or not? Was the problem solved or not? Right? So that's what happens today. So what Observe.ai came in and said, let's analyze every such voice recording, and they automatically, using machine learning and AI, and they automatically come up with a customer satisfaction score, an NPS score, and they come up with sentiment analysis of whether the customer was happy or not, and at the end of the call versus the beginning of the call. And they do this deep analysis of the calls. And essentially, now the company can get better call coverage, higher potential, accuracy, and all at a lower price. Right, and so that's what Observe.ai does. We are very bullish on them. We led the seed round. They raised the Series A from a well-known Valley VC, and they're executing quite well. They have 2 of the largest call centers in the world as their customers. They have companies like TripAdvisor and Square as their customers as well. And so that's on the company side. The way we found them is the founders are 2 engineers. One guy used to be a software engineer in Twitter here in San Francisco. The other guy was a software engineer in 1Mby1M in Bangalore, and they're both classmates from IIT. And when they were just ideating when they met us, and they had different ideas of what they wanted to do. But we met them and we liked the team, and so we kind of rolled up our sleeves and looked at different areas where we could build a product, and we encountered this particular area which was I felt ripe for disruption. So that's how we met them. The founder who was in Twitter, he had moved back to Bangalore because Twitter had acquired a company there called Just Dial, and he was leading the engineering there. And then after that, he left Twitter and started a company with his classmate from 1Mby1M. And we helped them find their third co-founder, which was a sales guy who had worked in this industry, in the call center industry. And he was super bullish about this particular space, and so he joined them, full time. And we helped the 2 founders interview this sales guy and sort of vetted him before he joined. And so, kind of the team got together, and we kind of helped them get to the first, product market fit. And even now, they're doing quite well. We are actively helping them find more people to join, and even bringing them potential customers. Yeah.
And when they started this company and when you wrote your first check, they did not yet have a product, or did they have the product already?
No, so they were actually building something else when they met us, and over the course of the next 6 months, they iterated and pivoted and eventually arrived at this idea. And initially, we wrote them a small check, and then we doubled down over the course of the year, and eventually led the seed round, right? So it was a, I would say, an extended dating period, but at the same time, we were actively helping them, kind of ideate and figure out what are the opportunities and so on.
So you invested in the team, really?
Yes, exactly. Yeah, I mean, that's the key, right? The stage at which we come in, the team is super important, and we need to see, that is one of the key criteria we look for, and we look for people who are on this high trajectory of personal growth. And whether in terms of what they have done in the past, in terms of how they interact with people, in terms of their sort of balance, in difficult circumstances. So we observe that, and it's difficult to do it in one meeting. So we do it over a course of 2-3 meetings, and we do reference checks and so on, and we try to form a view of the person. Because that is super critical at the stage we come in. It's more about the person than it is about the product or the market.
How many deals have you done that have this characteristic of investing in a team that doesn't yet have the positioning for their product or business figured out?
I would say about 1 in 4, so about 25% are like this.
25%, okay, good. That's pretty concrete. Now,
yep.
Can you talk about another example where the team was in place, but also they had more idea about what they were building and where the product positioning at least was further along, and then you can tell me what were the rest of the circumstances. I'm just trying to get a different viewpoint.
Yeah, sure. So this is another company of ours that's close to my heart. It's a company called Blitz.io with a double Z. And the founder, he's a pretty senior guy. He used to work in Oracle here in the Bay Area. And then after, so he's been in this database space for about 12 plus years. So he's a domain expert. He was in the core, database engine in Oracle, and then he joined a startup in San Francisco called MemSQL. He was a director of engineering there, the product and the idea was that when he was in MemSQL is a cloud database, a cloud native database, right? And so then MemSQL used to go into accounts and they would say, hey, buy a product. They had to show a proof of concept, right? And the proof of concept was, can you run this application that is already running an Oracle on MemSQL database, right? And even to do that that migration and to show that proof of concept was very hard for MemSQL. It would take them 6 months, 12 months to do this. So this guy had an idea, and he left MemSQL and started a company. And the idea was, how can we make this migration and replication of data from a traditional Oracle or a SAP database to this new age cloud native database like MemSQL? So he built a product for that specific use case, and then he came to us, right? And so it was a very well formed idea. This guy was a domain expert, and he knew what he was doing, and he pitched to us, and that's how we funded him, right? So it was a completely different case where the product and the market was sort of well defined, and the team. The team is obviously important, and this guy has the domain expert. He's one of the. He's published papers. He's a well-regarded person in this industry, in the database industry, distributed database industry. So that's another example. Yeah.
That's great. What you're highlighting is the tremendous desirability on investors' part of domain experts. This is something that we discuss a lot in the program.
Absolutely, that's exactly right. I think obviously there's an advantage to be an outsider into an industry, but as a startup, to be able to crack product as well as market while being an outsider alone is difficult. So if not all the founders, at least one of the founders needs to be from that industry, right? And they need not be a super domain expert, but somewhat of a expert in that industry, so that they know how to navigate into the market or the industry that they're selling into. Yeah.
But I mean, honestly, I hear from lots of investors that they're very ready to find, if they do find a real domain expert, the fundability goes up tremendously.
Absolutely. No doubt about that. Yep.
All right. Well, Alok, that was a fascinating conversation. Thank you for all your input, and I will let you go home.
Okay. Thank you, Shamana. Thanks for having me. It was a pleasure.
Great seeing you.
And
great seeing you.
Yeah.
Bye-bye.
Cheers. Bye.
Okay, folks, we are going to switch to the entrepreneur pitch section, and just want to set some expectations. This is a safe working session, so you can ask me any questions you want. We are here just to help you. There's no other agenda here, and you can safely discuss whatever issues you're dealing with. You don't need to be defensive. You don't need to be nervous. You may disagree with my feedback, and that's fine too. It's your venture, so you're going to do whatever you want. It doesn't have to be that you follow all my feedback. It's ultimately you're going to decide how you want to navigate your journey. One thing though, keep in mind, not all businesses can raise money, not all businesses should raise money, and raising money doesn't guarantee success. So you are going to need to keep that in mind and create a financing strategy that works. So those are some of the caveats that I'm going to set before we get in. We're going to start with Arvind Saraf. Arvind, I'm going to advance to your slides in a moment. All right, Arvind from Surat, India, please unmute your line and tell us what Wishbook is doing. Arvind, are you on the call? What's happening, Arvind? Maureen, I'm going to let you sort out Arvind's audio situation. In the meantime, if there are other people in the room who want to ask questions, please go ahead and start asking your questions in public chat. It looks like Arvind's call may have dropped. He will be dialing back in. But in the meantime, feel free to start asking your questions in public chat, making comments, or whatever it is that you would like to discuss from the audience. And also introduce yourselves. Tell us who you are, where you're joining from, what project you're working on. This is also a very nice networking opportunity. Usually we get lots of people from different parts of the world networking on this call, so that's also quite an effective piece of this puzzle. And so while you are doing all that, I'm going to point you to one thing that we're seeing a lot of right now. And those of you who are bootstrapping entrepreneurs, please pay attention to the platform as a service trend. There are lots of companies offering great platforms where a large part of the stack is already built. And if you're trying to get into an industry where there is a major player that's offering a platform as a service, this is a very nice opportunity to build a product with a lot of investment that other people have made. We can come back to that in a bit. Arvind, are you on the call?
I'm there. Am I audible now?
Yes, I can hear you now. Please go ahead. Yeah.
Great. Hi, thanks, Shona. Thanks. Sorry for the glitch. So let me just quickly introduce myself before I segue on to what we are trying to do as Wishbook. So I'm a computer engineer by education, BTech from IIT Kanpur Computer Science, went on to MIT immediately after that. Did a lot of interesting cutting-edge work in computer processors design, but then got interested in the whole idea of building tech-enabled solutions for emerging markets, which is when I opted to sort of come back to India 15 years ago. Google was setting up its India engineering then, so I was one of the first team members there. Spent about 3 years at Google starting my entrepreneurial journey. So I've been focused a lot more on emerging market solutions even throughout my 11 years of journey. My first company was a healthcare social impact company, one of the first companies funded by Surat Tata, who is one of the leading industrialists in India. So my family comes from this place in Western India known as Surat, which is like the textile capital of India. And they run a small, mid-sized apparel distribution business. 7 years ago, I moved back to Surat, which is not really an IT hub, but more of an industrial, commercial hub. Spent about 4 years running this brand. I was kind of familiar with the challenges that existed in this unorganized industry. Spent 4 years running this apparel brand before we started Wishbook. So let me just quickly give you a brief overview of what the fashion market in India and actually most of emerging market is like. So you have these manufacturing hubs, which are cities, mid-sized cities across the country, across places like Surat, where I'm based right now, which make apparel or product of a certain type. Now, these are not necessarily brands which retail directly. These manufacturers make product of a certain type, sell to wholesalers or distributors who are essentially aggregators, and these distributors then retail or sell to retailers within a 100-mile vicinity of them. Right? So you have this three-tier distribution system, and there are literally millions of such businesses that exist. So 3 million plus retailers in India, by some estimates, 100,000 plus manufacturers and wholesalers. Now you can imagine the inefficiencies that exist in such a distribution chain, right? So different companies use different softwares. A manufacturer has no visibility on its sales to its wholesaler. Wholesaler has no visibility on its sales to its retailer. Because the sales is not digitized, a company in this ecosystem has no visibility on the larger trends and feedback for them to plan, say, liquidation strategies or manage their debt inventory. Financial inclusion, and you talked about fintech. Financial inclusion in emerging markets is quite poor, which means retailers and wholesalers depend on their sellers, their suppliers, to give them products on a certain credit cycle. And fundamentally, that's either fraught with a lot of risk because the way sellers do risk assessment is highly vague and not at all backed by data. Or it creates unnecessary friction because a retailer is not able to buy less from whoever he wants to buy from. And yeah, so we set out to build a platform. Next slide, please. Next slide, please. We set out to build a B2B app-first platform which addresses these problems. And we look at this as a market network, a marketplace, plus a set of software services where we incorporate all aspects of the ecosystem. So next slide, please. So this is what the ecosystem looks like, which I just described a few minutes ago. You have a manufacturer selling typically to a wholesaler who then sells to a retailer. We built a platform where a manufacturer registers on Wishbook application, downloads and installs on the Wishbook application, uploads his product catalog there. Then he can keep updating new styles whenever he wants. Now he has two choices. He can connect to his existing offline buyers on the same application. When he connects, he sets in his trade terms there. So what is the discount that I may be giving to my specific distributor? What is my credit term with them? And mind you, so far this information has largely been in the minds of the seller and the buyer. It has not been documented in any other platform so far. He sets in the trade terms. Now his connected wholesaler, or for a wholesaler, his connected retailer, can view the manufacturer's catalog live, place an order there. The seller can update his order statuses. So they have a source of truth right from sharing catalog to orders, to order statuses, to payment statuses, which did not exist so far, apart from maybe WhatsApp messages that floated around. So that part captures the channel sales. My field guy, if I'm a manufacturer, when he's out in the field, instead of carrying a bunch of hard copy books and a bunch of paper, can carry the same application, show the catalog, and register his visits and place orders right there. Additionally, once I've uploaded my catalog, it's available on Wishbook Marketplace for new retailers that don't know me, to discover and transact with. And like any other sort of managed marketplace that have been happening in emerging markets, we take care of logistics, payments, and customer support post the order. We obviously use third party for most of these functionalities. Interestingly, and we talked about fintech. We talked about fintech in the prior conversation with Alok. I think so. We've sort of used our domain understanding, the fact that we know what's happening in the offline transaction space, to come up with our own credit rating metric, a proprietary credit rating metric for a retailer to get rated. So a retailer, while he's using Wishbook for discovery and keeping track of his offline transactions, he may opt to get himself credit rated, where we use signals beyond what the conventional fintechs use. We use a lot of reference check mechanism, a lot of offline data that we captured from the channel sales history to give retailer a credit score against which NBFCs or fintechs tend against it. And to the same retailer, we give him a bunch of sales tools as well, so that he can easily, since we have a supply integrated, with a single click, he can create his own website, share his catalog there, do some social selling if he wants to, have a stock ship to his customer. So essentially, a marketplace is a place to sort of get the merchants in, give them benefit of new business or new suppliers, because with emerging market businesses, we have seen a premise of new businesses much more quickly adopted, but services around them to sort of make them a little more sticky and deliver a longer term higher value. Next slide, please. So a few more details about the channel sales platform. So I can manage my buyers, manage my field force, track my orders and payments, and get a lot of interesting analytics from the business dashboard. Next, please. Some screenshots are there. It's essentially app first. With this is the B2C extension that we talked about, where we give retailers with a single click his own private site, white label completely with them. And it just has to set the margins to get the site up and running. In terms of traction, so we opted to sort of take while our larger goal is the entire fashion lifestyle category initially in India, we took a subsection of fashion lifestyle category, which is women's ethnic wear, women's Indian ethnic wear. We picked up two of the largest sort of fashion hubs of India, Surat and another city in Gujarat, in Western India, known as Ahmedabad, to onboard sellers from these locations. So we now have 1,000+ top manufacturers, brands which are not retailing or which are not sort of selling on any digital platform as sellers here. We've given them these 200,000+ retailers, 50,000+ monthly active retailers, and without any marketing spend, we have seen monthly 20% month-on-month growth. So we do an annualized GMV of about 2 mil USD, about 16 crore INR, with healthy gross margins of about 12+5, about 17% gross margins. So they're transactionally profitable already on the marketplace. On the channel sales, we have one large manufacturer use our platform. A lot of these use cases on the channel sales have come in from my own experience running an apparel brand. Next slide, please.
Before you go on, Arvind, what is the marketplace commission that you're charging here? What is the business model you're working with?
Right. So on the marketplace, we charge on transactions. So currently, we do about 12% transaction fee. This is a blended fee. So based on the category and the type of customer, it changes, but this is what comes to. Plus about 6% shipping fee, which is essentially a pass-through to our logistics providers. On the channel sales part, we haven't.
Okay.
Sorry, please go ahead, Shravan.
Channel sale was one of my next questions. Like, what is the business model for channel sales?
Right. So we haven't started monetizing that yet. I think so. We are looking at a subscription structure there, because this is to manage my existing sales. So obviously, a transaction pricing will not make sense. Having said that, we have also seen channel sales in the limited deployment that we have had pay off by creating some semblance of stickiness amongst the merchants. So monetizing channel sales is not a priority for us. We want to get more adoption traction in and let that sort of feed off on the marketplace. But yeah.
Okay. Was that your next slide? I wasn't. Is that your next slide?
Yeah. So essentially, so this is one sample retailer we have, who's essentially a small retailer in Varanasi, a mid-sized city in India, where historically he is dependent on his local wholesalers to give him supply, and now with Wishbook, through the marketplace, he is already bettered his supply better than most wholesalers themselves. Next slide, please. We talked about different user types. I think, I'm sorry, some of the numbers are in crores and lakhs, but manufacturers, we have value prop in terms of giving them new business and helping them manage their existing business. Retailers, choices, supply that they did not have at the best wholesale prices, and some bit of working capital as well. Next slide, please. Credit we talked about. So credit is the single biggest risk a manufacturer or a wholesaler, anybody in this ecosystem carries by capturing a lot of information automatically from the Wishbook app, subject to the retailer opting to get himself a credit line. We make the process largely seamless. We capture his bureau score, his bank history if he uploads it, get his reference feedback, all go seamlessly from the application against which he gets a credit line, and that becomes like a payment mechanism that he has. Right? So instead of sort of
is that something you have validated? Is this happening already?
Right. So we've done a small pilot. We haven't scaled it up yet, but we've done a pilot where we saw through our own credit line, we saw 100% recovery. We worked with the fintech with some of these signals as well as a small pilot, but we haven't scaled that yet.
Okay.
So we see a high level of conversion happening from our users. So from the 50,000 plus monthly active users, we see at least 3,500 to 4,000 of them transact, and that's 7 or 8%, 7% plus conversion rate, which is probably unmatched by e-commerce industry in India. And that's because we use a lot of machine learning to recommend the right products to the user. The sheer scale of SKUs, we get about 2,000 SKUs, 2,000 plus SKUs on a daily basis. A retailer will not be able to browse through that unless there's a lot of data-centered machine learning sort of recommending him the right products to view.
Yeah.
Credit is where we use sort of a lot of data. And once we start the channel sales getting a lot more traction, I think the dashboard and the analytics that we can suggest to the manufacturers on what they should make, what they should not make, the future sort of trend forecast can fundamentally bring these guys to a much high level of efficiency. Our goal is, can these manufacturers or wholesalers work at the level of efficiency of a Zara, even if they don't have the technology know-how or the scale to sort of invest in such systems and processes? Next slide, please. So I think, this is a slightly complex slide because of so much happening in B2B space in India. So there are people who are trying to sort of focus on solutions for SMEs. There are people who are trying to do it for large companies. There's companies which are taking a marketplace and approach another set of companies on the software SaaS side. So I think we realized that to really B2B has to be very category aware approach. So we took a fashion lifestyle category focused approach where we understand that it's a fragmented space, and to really build a very large solution, I think SMEs are what we need to focus on. And we're probably the only platform which sort of combines and leverages the use case of a marketplace and a software SaaS. And that's probably because we spend a lot of time, I personally spend a lot of time running a brand where I could get the SaaS use case out, right? The software services use case out as well. Not many interventions so far in this, trying to sort of combine a software and SaaS, software and marketplace use case in India so far. I think the closest example I can see internationally is Zilingo, based out of Southeast Asia, trying to do something similar. Right? But it's a large space that of intervention. In terms of team, I introduced myself earlier. A lot of tech and product, and then 11 years of entrepreneurial experience. Like 7 years now in this apparel industry. Ankur handles field sellers, onboarding for us. 17 plus years of experience on field team management. Gets how to manage the sellers and get onboard them in a very, very cost-effective manner. Gaurav is an ex-entrepreneur, strong business and product sense. Jay is a strong computer science graduate, worked with me for about 5 years prior to Wishbook as well. We've had some of the leading investors from India, InfoWish, which runs some of the leading internet portals in India, as one of our investors as well. Next slide,
How much have you raised?
We've raised about 900K so far in a seed and part seed Series A. 900K USD, so about 6.5 crores so far.
Okay.
In a small pre-series A, part pre-series A round. So I think we've already sort of started getting recognized by as one of the sort of more innovative fashion-centered startups, B2B-centered startups as well. Yeah. So I think more specific sort of questions. And these are questions that I sort of keep thinking a lot about, is So we've seen certain action happening in B2B space in India, and I think a lot of the emerging markets where there are companies which are just purely chasing the GMV numbers without necessarily focusing on one school of thought without sort of focusing on unit economics, and the other, I think we have leaned more towards focusing on unit economics and delivering value. And I often hear this feedback where, look, capture the market, we'll figure out the monetization later, right? So that's a question that but I've come in from a DNA of building a very bootstrap businesses in the past as well. So the question that I asked myself, we started from Surat, which is not necessarily an IT hub, but a place which has given us good close access to market and help refine the product. But at some point of time, I think we believe we should be closer to the talent to really scale the organization way beyond, and what is the timing? I think these are questions that I sort of...
you want to brainstorm about. Okay, sure.
Yeah,
so I actually don't think you don't have to forego your focus on unit economics to scale and capture the market. I think that, assuming that you're going to go on to raise more money that will give you a greater capacity to capture the market, I think you've delivered very well on your early metrics and milestones and validation process, such that there will be interest from follow-on investors. And when you do succeed in getting more money into the company, I think you are going to put more money into finding, into market capture, but I don't think you should do that at the expense of unit economics. I don't see the point of, there is some beauty in a business model that has unit economics in view right from the beginning. If you look at the media, you will constantly hear stories of implosions of companies. We have this death by overfunding series. You can read up on my deep death by overfunding series. There's constantly overemphasis on market capture and lack of attention to unit economics. You don't need to go that route, right? You can do it. You can do a solid market capture strategy while not losing sight of unit economics. That would be my strategy. And you figure out the detailed subtext of that, of exactly how you're going to do that. What would be your customer acquisition strategies that don't upset your unit economics? That would be my challenge to you, and you have enough intellectual horsepower in your head to be able to figure that out, I think. That's number one. On Surat versus Bangalore, closer to the market versus closer to the talent, I actually have the opposite point of view. I would prefer that you're closer to the market, and you should be able to. Surat has some amount of a technology industry. To the extent and I think given what's happening in India by way of talent and the talent wars, it's better that you maintain a Surat operation even from the technology point of view. Maybe you need a Bangalore operation or some other place operation where you attract the talent in and get, do a two-place. You don't need to shift out of Surat to be in Bangalore. I wouldn't do that, because there's going to be a certain number of people you're going to have to bring in to scale this operation, and that scaling you're better off doing at Surat and keeping a small Bangalore office for some high-end talent that is going to help you, address those issues, those types of skill sets that are not available in Surat.
Fair.
Make sense?
That makes sense. I think with growth, I think we've been able to grow 20% plus month on month without any sort of net burn. So our burn has been constant when we were a tenth of our volume. So that growth, I think we've been able to maintain. I think so fair enough. I think and focus on unit economics hasn't come at the cost of growth. Sure.
There we go.
Sorry.
So you're going to, of course, the minute you get into a full-fledged institutional venture capital discussion, they're going to want you to grow even faster. And that's when the questions are going to arise on what are the levers that you push to accelerate. You should, before you go to meet investors, this is a question that you should map out, is what are the levers that you're going to push to achieve a higher growth if capital is available? And that's really going to be, the whole question around this is going to be, this business is going to be around that issue, is what are the levers for accelerating growth? How do you press the pedal to accelerate? The other thing that you need to be aware of a little bit, where this question is going to be very critical, is in India, if you look at what's happening amongst the investors, very often there's a resistance amongst investors who have to deal with business ideas or businesses that are Indian SME-facing businesses, because those markets don't tend to grow very fast. So that is a question that you're going to encounter, and you better have an answer to address that.
And in fact, especially with the software SaaS models, whether people pay or not, I think there haven't been many sort of businesses which have been viable charging Indian SMEs for software or SaaS services to a certain scale, I think true. I think the marketplace is where we see a lot of revenue stream coming in. I'm myself a little unclear about the market size that we could capture with SaaS, but the stickiness part is where we see a lot of complementary value coming in. But fair.
Right.
Yeah.
But you know what I like about your situation and your background, you have, and I think this is true about entrepreneurs from your part of the world, is that I think you know how to be scrappy, you know how to bootstrap, you know how to be frugal. So don't lose sight of that skill set and that, internal wiring. Your family, I'm sure, has that wiring, and I'm sure you inherited that wiring from your family. So don't lose sight of that wiring.
No, I think I inherited a little too much, probably. Maybe should yeah. Anyway.
Does that give you sustainability?
Yeah.
True. Why does a Guild Group or a Nasty Gal, all of these are fashion companies, why do these companies go out of business? They had no business going out of business. They went out of business because they started spending so much money without the fundamentals in place. Never get into that kind of a vicious cycle.
Yeah.
Very good. It's great. What you're doing is excellent. Very, very nice work.
Thank you.
All right.
Thank you.
So, folks, if you like what we're doing here, please refer serious entrepreneurs into 1Mby1M. Serious is in bold, because we need to only work with people who have the capacity for spending years building a business, because it takes a long time to build a sustainable business. All resources from 1Mby1M are available at 1Mby1M.com. There's a blog that if you follow the blog, you'll learn a lot just by following the blog, and it's free. There's a set of 12 books, case study-based books under the Entrepreneur Journey series title, and each of them have 12 to 16 case studies. This is also very good learning material on different topics related to entrepreneurship. These roundtables happen every week, so you're welcome to come back as much as you want to and use these as learning material, and the recordings are also available for you to use as and when you want to. Our full acceleration program is 1Mby1M Premium, and you get extensive methodology guidance there. We have a full curriculum that will teach you a lot of the pieces of how to build a business. Where we have connections, we make those connections available to you. So we do have help for business development available. We have a tremendous Rolodex in this industry. We have strategy consulting similar to this format, but in private members-only roundtables. That's whatever you call it, mentoring, coaching, strategy consulting, whatever it is, the interactive feedback on your businesses and on your strategy and brainstorming. We do help you with financing. We don't immediately introduce you to investors unless you are fundable out of the gate. So there is a process of getting you to the right set of collaterals and strategy and metrics with which you can have a productive funding conversation. And if that is not there, then we will wait and we will work with you to get you there. All that is part of the premium program. We recommend that you go through the self-assessment on our website. It's a free questionnaire. And these are questions that investors would ask you. We suggest that you ask these questions of yourselves, of your own business. If you get stuck on methodology points, go to 1M1M Basic and study the curriculum and plug the methodology gaps. This is very important because often first-time entrepreneurs have to, do a lot of methodology learning to be able to put one foot before the other, and that's all available through 1M1M Basic. So in any case, go dig around on the website, understand what the program is all about, how it's delivered, and see if it suits you. There are video FAQs, lots of material on what to expect, a full description of the curriculum. It's a case study-based program. We have over 1,000 successful entrepreneurs who have participated, contributed their case studies based on which we've developed this curriculum and synthesized the lessons from their trenches. There's lots of synthesis videos. So it's a very efficient way to learn, to kind of climb the very steep learning curve of an early stage first-time entrepreneur. Our methodology is lean, capital efficient, bootstrap startups. Bootstrap first, raise money later is our mantra. That's it. We have a lot of clout in the media. We get the word out about your business through that clout. We have roundtables every week in October, so please come as much as you want to. If you want a slot to pitch, be sure to register to pitch. And we also have 3 in-person rendezvous in Silicon Valley at Cafe Boroni. If you're local or if you're visiting the Bay Area, you're very welcome to come by, and I look forward to meeting you there. That's it. We're ready for Q&A again. So either call in or start typing your questions and comments into public chat. I'm going to go there. Let's see, Christian Mendelson has some comments. Sarah says, I'm Sarah in San Francisco, not at all sure what I'm doing yet, something about psychology. Okay, Sarah, for you, I think some methodology would be helpful if you haven't done this before. In the ideation period, if you start following methodology, everything is going to go much faster. Christian from Monterey, bootstrapping an idea, only an idea. Next step is market research and validation. Been attending all the startup meetings in Silicon Valley as I can, getting excited because when I share my idea, others become engaged and involved. That's good. Just here to take information. Very good. All right. Any other questions, comments? While you're typing in your questions or dialing into the call, let me introduce you to Irina Patterson, Irina at 1M1M.com. She is on the 1M1M team and will answer any questions you may have about the 1 million by 1 million program. Anybody? Any questions, comments? Anybody wants to dial in? Now is the time. Yes, no, questions, comments? So, folks, I'm going to go back quickly.
I have a question coming.
Yeah, who is this? Could you please identify yourself?
Hi, I am a student here in America.
Uh-huh. And your name is?
My name is Tony. Hello.
Okay. Yes, go ahead.
I'm interested in understanding. I'm coming out of college with a degree in psychology. I'm thinking of switching over to business because I'm interested in where business and psychology is going to cross in the future. Where do you see it crossing in the future?
Well, I mean, from what perspective are you asking me this question? Are you asking me this question from the perspective of entrepreneurial opportunities in the cross-section of psychology or business, or are you asking it from a career evolution point of view?
From an entrepreneurial point of view.
Entrepreneurial point of view. Well, I mean, you know, the classic way that psychologists have created businesses in the corporate world is through executive coaching and, that kind of area, that kind of field. And that's one field that, I could see there are opportunities that you could use that model and actually do product-based businesses. There's going to be a lot of AI that you can apply to that intersection of psychology and business, and that would be interesting. HR, we talked about earlier with Alok, we talked about HR applications of AI, and there, if you can build in more psychology perspective into the AI that helps you make better hires, better hiring decisions, those are all opportunities where you could apply psychology into business.
Okay, thank you.
You're very welcome. Anybody else? So folks, while we're waiting for more questions, I just want to go back a little bit to my earlier comment about PaaS. So many of you are bootstrapped entrepreneurs, and that's, very much in our sweet spot in our community. There are numerous entrepreneurs bootstrapping their businesses. Do pay attention to the platform as a service trend. There are a lot of platforms out there that have a large chunk of the stack, the technology stack already built up in different domains and different kinds of technologies. And if you're building on top of one of these stacks, you save an enormous amount of money. And many of these PaaS ecosystems are offering go-to-market help as well and access to their customers. You'll see us talking a lot about this in the upcoming months and quarters. I think this trend is a very meaningful trend, and for entrepreneurs, it's one that you should absolutely pay attention to. And if you go back to what has happened in the industry so far, Salesforce.com has done one of the greatest executions of a PaaS strategy with their Force.com platform and App Exchange. They've done an incredibly sophisticated and successful implementation of PaaS. And on top of that PaaS platform have been created companies such as Viva, which is now a multi-billion-dollar successful SaaS company that was built on the Force.com platform. Aptus is another very highly valued company. There are numerous. Cloudify, I think, is another one. So there's a number of very, very interesting companies that have developed out of this ecosystem, the Salesforce.com PaaS ecosystem. And taking that playbook, there are numerous other SaaS companies that are currently launching or building PaaS platforms. So if you're looking to make platform strategy decisions, do keep all this trend in view as you make decisions on what platform to build upon, because you may have access to great accelerator engines, both technically as well as go-to-market wise, that are going to be very helpful going forward. You'll hear me talk about this constantly in the upcoming months and quarters. Okay, any other question before we adjourn the session? I don't see any more questions in the public chat, and I do not see any hands up or any other call. Oh, okay, Abhijit Datta, you have a question. Don't send me private chats. Everybody in the room needs to see your questions so that I can efficiently take the questions and answer them. So when you're using the public chat to ask questions, make sure you turn your chat to send to all participants, okay? Go ahead. Abhijit is typing in his question. Is there anybody else who has a question that you want to talk about? What about Sarah? Sarah, you had something. Abhijit, I don't see your question. I'm not sure where you posted the question, but it hasn't shown up in public chat. Here we go. Any interest in game-based learning tools? I have a card game on design thinking. Do workshops with companies like Samsung besides early growth stage startups. Want to scale this to reach many others. Well, Abhijit, you should do your research on what other, what other products exist in game-based learning, especially in the context of what you're doing to teach design thinking, and see what the competitive landscape looks like, and create a strategy, at least a straw man strategy, and you're welcome to come and pitch at one of these roundtables. I'll be happy to give you more comments. You need to, my suggestion would be hold off on building a virtual version of the game. First, do the business case analysis of what would it take to take this product to market, and then make the investment in building the game. In general, our take on early stage startups and ideation is that do the full ideation with proper due diligence, proper research, proper modeling, TAM modeling, and so on and so forth, so that you have a good idea of what kind of a business are you going to be building, and then invest in building the product. Because very often we see entrepreneurs spend like 2 years in building a software, and then they can't sell it. So it becomes solution looking for a problem. Very good. So then you have at least some level of validation that should give you a lot of edge in when you decide to actually build the company that in a more scalable way, Abhijit. So if you have that validation, that's excellent. Okay, anybody else? Abhijit, did I answer your question? Are you all set? All right, we're going to adjourn for today, and we will see you next week, and look forward to working with you more this fall. And there are a lot of exciting things happening this fall, so you will see those announcements coming right up in the next few weeks. Bye-bye, everybody. Thanks for coming today.